Hey guys, welcome to Market Uncharted, the second video after we clarify a few definitions. Let's talk about strategies, option strategies. And you can see here the process chart, right? Buyer, seller of a stock option, set price, expiration date. We already review all of these definitions. Now let's see 7 option strategies that every trader needs to know. And don't forget the last one, the 8th, it's my favorite one, covered call, will go there on the next video. Options not only offer an investor leverage in the market, but they also offer potentially less risk if utilized properly. Moreover, they allow an investor to make a smaller investment to control a large amount of shares in an underlying asset. When considering options, there are many ways to structure them, and I will cover that I consider to be the 7 most important ones here. Options can be either bought by a trader or sold by a trader. If a trader chooses to buy an option, the order is buy to open. If a trader chooses to sell an option, the order is sell to open. Either of these can be reversed at any time if the trader wants to exit their position. If an option is bought, he or she would sell to close, and the other way around is also true. In general, I personally like to bet a net seller of options. Being a net seller of options allows me to collect a premium on my trades up front. Now let's talk about the first strategy. This is the iron butterfly. If you are a trader who is somewhat risk averse, consider the iron butterfly strategy. This option structure is less risky, but still potentially profitable. This approach to trading is good for generating steady returns on investment with low risk. This strategy helps cap risk, but still offers the ability for a good return on investment. With the iron butterfly strategy, an investor will sell at the money put and simultaneously buy an out-of-the-money put. To complete this strategy, the trader will also sell an at-the-money call and buy an out-of-the-money call. All options must have the same expiration date on the same underlying asset. Second one, the Long Strangle. The long option strangle is an unlimited profit, limited risk strategy. This strategy is utilized when the trader believes that underlying stock will encounter high volatility in the near term. Significant gains are attainable when the underlying asset makes an especially strong move either upwards or downwards. To set up a long strangle strategy, the trader will purchase an out-of-the-money call option and an out-of-the-money put option simultaneously on the same underlying asset with the same expiration date. The Long Straddle. The Long Straddle option strategy offers unlimited profit while limiting the risk. This strategy is used when the trader believes that underlying asset will experience considerable volatility in the near term. A Long Straddle strategy can be set up as follows. The investor simultaneously purchases a call and a put option on the same underlying asset with the same strike price and expiration date. The bear put spread. A bear put spread is a strategy executed by a bearish investor who wants to maximize profit while minimizing potential losses. The bear put spread is set up by concurrently purchasing put options at a specified strike price and then selling the same number of puts at a lower strike price. Both options positions are purchased on the same underlying asset and have the same expiration date. And now my favorite one as well, and this is important because when we are in a bull market, this is especially interesting. A bull call spread is used by a trader when she or he believes the underlying asset price will increase in value. To set this up, an investor will simultaneously buy calls on an underlying asset while also selling the same number of calls at a higher strike price. Here, both options will have the same expiration date and be on the same underlying asset. Then we have a long call butterfly spread. A long butterfly spread is utilized by investor when she or he believes that the underlying asset will not rise or fall much by expiration. This is a limited risk strategy. With a long butterfly, we use call options, and the investor will combine both a bull spread strategy and a bear spread strategy. Here, the investor will be using 3 different strike prices, with all the options having the same underlying asset and expiration date. You set up a long butterfly spread by purchasing one in-the-money call option at a lower strike price, while selling 2 at-the-money call options. Then we buy one out-of-the-money call option. Then we have one of the most well-knowns in the market as well, the Iron Condor. The Iron Condor options strategy allows the traders to profit in a market that is trading sideways, which is meaning consolidation. To set up the Iron Condor strategy, an investor simultaneously holds a bull put spread and a bear call spread. Iron Condor is created by selling one out of the money put and buying one out of the money put at a lower strike. To complete this trade, the investor will then sell one out of the money call and buying one out of the money call of a higher strike. All the option positions used to set this trade must have the same expiration date and are on the same underlying asset. So thank you guys so much for watching this video. Never forget, knowledge is not power, knowledge is potential power, execution is everything. Options trading is very risky, but can deliver really good upside if you trade it correctly. And don't forget, just like the markets, we will not rest.